Hello everyone, it's Friday, January 30, and today we will analyze the charts for the euro and the British pound to identify potential market moves. Yesterday, demand for the US dollar increased. However, this uptick does not reflect its underlying strength, but rather developments unfolding in other markets, particularly the stock market, which plunged on Thursday. Thus, Microsoft shares fell by 12%, marking their largest single-day drop since 2020. Weak reports from major corporations have heightened investor concerns about AI spending, with many believing that the recent hype surrounding AI has resulted in a significant overestimation of the technology's current capabilities. The precious metals market also saw losses yesterday, with gold and silver retreating from their all-time highs. The same downward trend was observed in the cryptocurrency market. These developments collectively provoked a brief return to the greenback, which strengthened it against both the euro and the British pound. However, this does not indicate a market reversal, but rather a redirection of capital. As it stands, there is no question of a long-term uptrend in the dollar. Additionally, traders received data on US weekly jobless claims, which came in below the prior week's figures but exceeded analysts' expectations. Data also revealed that the trade deficit in the US widened sharply to $56.8 billion USD, indicating that imports continued to rise while exports remained stagnant. Now let's take a look at today's macroeconomic calendar. It features GDP growth data from France, Spain, Germany, and the euro area as a whole. Eurozone GDP for the fourth quarter of 2025 is projected to rise by 1.2% year-on-year and 0.2% compared to the third quarter. In addition, market participants will be focused on December unemployment data from Germany and the Eurozone. A decline in unemployment could help the euro maintain its leading position against the dollar. Later in the day, attention will shift to US producer prices, which are estimated to have fallen to 2.7% in December, while core producer inflation is expected to edge down to 2.9% from 3%. Signals of easing inflation could allow the Federal Reserve to adhere to its current policy stance through this summer before resuming interest rate cuts. Furthermore, traders will likely pay attention to a speech by Fed official Alberto Musalem along with the Chicago PMI. Encouraging US statistic could trigger dollar purchases, but it seems that only significant redirections of capital could enable the greenback to recover. Turning to technical analysis, the 1-hour EUR USD chart suggests that a decline followed by a false breakout at 18.97 would trigger a buy signal, pushing the euro up to 1948. A break in consolidation above 1948 would bring the euro to 1992 and likely open the path to 1.2037. At this level, I would recommend going short on the rebound, aiming for a 30-35 pip pullback. Short entries at 1948 and 1992 should be considered only after a false breakout. If buying interest at 1897 proves muted, consider postponing long positions until a deeper pullback to 1852 or even 1810, where it would make sense to go long on a rebound, aiming for an intraday correction of 35-40 pips. Going long at 1852 and 1897 would be relevant only in the event of a false breakout. Speaking of the British pound, a failed breakout about 37.33 would trigger a buy signal, likely pushing sterling up toward 37.88, the midpoint of the sideways channel. A break in consolidation above this level could extend the move to 38.43, with sterling possibly extend gains to a new 1-month high of 38.99. While an extension to 38.99 is less likely, I would recommend going short on a rebound there, targeting a 35.40 pip move. Short entries at 38.43 and 37.88 should be considered only after false breakout. If bulls fail to hold 37.33 and selling pressure takes over, it would be prudent to consider long positions at 36.86 on a false breakout and 1.3644 on a rebound, in anticipation of a 35.40 pip move. Good luck to everyone. Have a nice weekend.